Hello and welcome to Charting the Markets. It's Monday, the 20th of February, and by and large, European markets are treading water. That comes in a day that's most likely going to be a relatively slow start to the week. That's because we do have the US and Canadian markets offline this afternoon, President's Day being celebrated over on that side of the Atlantic. And certainly, if we're looking at the wider themes coming into this week, it all has to do with the fact that the data recently has pointed towards a continuation in terms of the downside move in inflation, most notably a pickup here in the UK in terms of that downward trajectory. But also economic strength. We've seen record retail sales over in the US. We've seen unemployment plunging further towards the downside, showing no sign of really turning upwards. UK unemployment certainly relatively a strong picture we're seeing out of the UK. So the high interest rates we're seeing from the central banks at the moment having very little impact on the economy. And the payrolls number, a similar kind of story, massive outperformance on that front. So everything pointing towards an economy or economies that are able to withstand further upside for interest rates. And over the past week, we have been seeing the expectation and the pricing around interest rates pushed higher yet as people expect to see further upside in terms of rates. We have been hearing from some of the Fed members, which essentially allude to the same thing. They're expecting to have to continue to push interest rates higher in a bid to really drive down inflation. Once inflation is hit heavily and we're back down to relatively decent levels, that's when we're likely to see the Federal Reserve flip and start to become more accommodative. But certainly the pressure for them to do so is minimized with the fact that the economic numbers at the moment are relatively positive. The key thing for me, I think, is going to be housing costs. Some of that is going to come down to the fact that, well, housing costs are more expensive with interest rates rising. But a lot of it is also down to energy prices. Energy prices should have come down very dramatically with the fact that natural gas, both in Europe and the US, have really collapsed over recent months, but it hasn't fed through to consumers yet. So when we start to see that fed through with the fact that these businesses, that energy companies need to renegotiate and move on to new contracts for them to receive their gas, once that feeds through to the consumer, to the businesses, I think that's going to have a dramatic impact in terms of inflation and really drive it further lower. And that would come to the benefit of stocks. At the moment, the worry is, well, we could be seeing higher for longer in terms of interest rates. And therefore, we're seeing some risk off sentiment coming into this week, which lifts the US dollar. Looking at the indices space, we've seen the FTSE 100 outperform of late. A lot of that comes down to the fact that, well, ultimately, we're seeing the US dollar start to strengthen a bit. That does provide weakness for cable, and that is for the inverse correlation between the two. That is a positive for the FTSE 100. So we've seen it moving onwards and upwards, and certainly the weekly time frame shows you exactly that, up into record highs last week, a little bit down from there at the moment. Onto the daily time frame, you can see here we've got this ascending trend line in play down below. Let me see if it extends out much beyond that. Not particularly. I mean, you could maybe grab this and also draw a wider trend line here as well. So we've got sort of two trend lines in play here, which gives us sort of zone of support worth noting. Essentially, we've got a very clear uptrend in play, and the 4-hour chart's going to give us the information we need here in terms of how things are playing out over the near term. So firstly, we've got this trend of higher lows in play. That is going to be a key thing here. We haven't managed to break up through that prior swing high, and therefore, the key swing low that we're looking out for at the moment remains 79.21. If we break through that prior high, then we'll be looking for this swing low around about 79.53. At the moment, starting to roll over. If we do roll over and come back into this zone of trendline support, then you're looking for a potential buying opportunity. If we start to break down and start to break your 79.20, potentially your 78.49, that's when we look to be reversing the wider move for this market. So in particular, 79.20, if we break that level, then it starts to look like we could be in for a more protracted move towards the downside. Until that happens, we're likely to see further upside come back into play soon enough. So near term could see a pullback, but I think this zone down below looks like an area where we'll soon enough see the bulls come back into play to see further outperformance for the FTSE 100. In terms of Germany, the DAX is in this consolidation phase. We can see here in terms of the boxes, these sort of rectangular boxes that I have drawn onto this chart. the prior period of consolidation, the breakup through resistance, moves us into this next zone. That's exactly where we are at the moment. So yes, we could see a move towards a downside, but with that area comes the prior resistance and prior support, which is around about your sort of 152 kind of area. So, at the moment, looks like we're sort of rotating between that. And with the fact that we're sort of rolling over at the moment, maybe we see a period of weakness for the day ahead to move us back down towards that zone. But at the moment, this is very clearly a range-bound market that has been dominating much of February thus far. And therefore, any near-term downside is likely to be bought into once again. Look for, if we were to see a pullback towards support, look for some of the prior signals that we've seen. So one thing could be a long lower shadow. One thing could be, this would be an intraday sort of double bottom formation. This would be the similar kind of thing here. So, you could have bought on that exit and put stops below this level, and you would have been able to see a move up into this top end here. You could do the similar kind of thing here, and you would have been able to see a nice risk reward move back towards the top end of this. So near term, I do think there is a chance that we see some weakness coming into play and we drift lower once again. But as things stand, we're just staying within that range. And that range ultimately is set within a bullish trend. So the exit from this pattern is expected to be bullish, but we haven't seen it quite yet. We're going to look at US markets. They're still tradable, despite the fact that we are seeing US markets close today with President's Day. But nonetheless, this is, of course, a very interesting one. The NASDAQ, of course, the wider bearish trend playing out for these tech stocks, more recently rallying up into this 76.4 Fibonacci level, as we see here, and we're looking like we could top out here. Are we going to top out, or is this going to be range bound? Well, we don't necessarily know. What we have seen here is it's a 61.8 fib, which currently comes at 122.30. That was tagged previously. We rebounded back in towards this prior area of resistance, sold off once again with that bearish engulfing on Thursday. Now we've tagged the 61.8 again, and now we're consolidating. So as things stand, it just looks like we're consolidating here. But certainly there is a wider bearish trend to consider here. With the fact that we've come in towards this 76.4 fib and now started to provide this pattern, which is very different from everything that we've seen in the lead up to this, there is a chance that we're topping out here. But really, we'd need to start breaking through your, say, 122.30s to provide a potential topping pattern here. Here is the 4-hour chart, as we can see here. We could get a double top formation with a breakdown through 121.94, although greater confidence comes with a breakthrough 118.17 for the NASDAQ. As things stand, though, we're still within this sort of range bound move. So we would need to break this 121.94 to really start telling a more bearish picture here for the NASDAQ. Looking at the FX space, we've seen the US dollar coming back into prominence as we see worries over the idea that the economic strength exhibited through recent jobs data, recent retail sales numbers, and the like, that could essentially lead to the Federal Reserve raising rates and keeping them higher for longer. That has been something that we've heard from different members, and we've seen the US dollar strengthening off the back of that. Well, the wider trend here for euro dollar is a bullish one. You can see the pullback that we've seen over recent weeks has taken us back down in towards an area that could provide support for another move higher. If we look at the Fibonacci, we can see that this move thus far has taken us absolutely perfectly into, let me just draw this correctly. There you go, into the 76.4 fib. So the fact that we've tagged that and moved higher and ended up in the green, that was on Friday. Does this mean that we bottomed out once again and we're going to see the bulls come back into play here? That is a distinct possibility. Look, if we're looking at the trend for this move, you can see that the shorter term trend is generally reflected within a move like that. So you see a consistent uptrend, nice higher highs, higher lows. Then we see a breakdown from that and we're retracing a wider move. That happens time and time again. On this occasion, we've seen a more protracted sort of wider move lower. Once you break out of this intraday move, you break through your first swing low, then you're looking at that wider retracement of a 104.83. Now, there is a good chance that we could be reversing the entire move. We could be selling off from this entire move, but that would take a move through 104.83. What's the signal that we are retracing and we're going to move higher versus what's the signal that we are essentially going to top out here? Well, it comes down to whether we actually do respect any of these Fibonacci levels. That would tell us that markets believe that this is a retracement. And as things stand, it's absolutely perfectly respected it. But We're not out of the woods yet. The bulls don't necessarily have the opportunity to celebrate too much because we still trend within this pattern of lower highs and lower lows. In particular, the lower highs is important here. We did flash up into a new peak here, but ultimately sold into new lows. So what we'd need to see to gain confidence that this rebound that we've seen from that 76.4 Fibonacci level is the beginning of a bullish phase is a move through 107.22. A move through that level would point towards the possibility that the bulls are back in charge and that this bullish trend that's been playing out since the beginning of October is going to continue. So, like I said, the short term still has the possibility of us rolling over. And as you see here, we've got the potential for a bearish engulfing. So this bearish trend does remain in play unless we break up through this swing high that we have here at 107.22. So a move through that level brings about a more bullish mindset. Until that happens, there is still a good chance that we see this market on the back foot once again to move back towards that 106.13. If we break through that level, then again, that starts to give us greater confidence that we are going to see a wider reversal for this market. But certainly arguments on both sides, but with the fact that we've rebounded and started to look like we're going to see a bearish engulfing, I think there's still a good chance we do see some weakness ahead for today. And a move through 107.22 would be required to point towards a potential bullish turnaround from here. In terms of cable, we've seen this market rally up into the prior high of 124.47 and selling off once again. We've got the possibility of a double top formation with a break through this neckline of 118.41 required to complete that pattern and point towards a wider sell-off for this market. Now, is that going to come to fruition? We don't necessarily know. We've got this 100-day SMA and the 200-day SMA confluence down below. It has been respected, the 200 last time around, but not necessarily prior to that. So is this zone going to hold up price? Well, we did see a move higher last week. It's a similar kind of story in many ways. You can see, let's just get rid of this level here. You can see this bearish pattern playing out, and therefore this rebound could just be a precursor to us selling off once again. But 118.41 is the key level for that double top formation to complete. And until then, for us to start looking at this in a little bit more of a positive light, we'd need to see a move through 120.74 broken. The only thing with that is that ultimately, that just looks like a portion of this leg lower. So, we would need to break all the way up through to this 122.72 level, which is some way away from where we are at the moment. But certainly it would look more positive if we break the 120.74. And until that happens, and there's a good chance we do start to turn around from here and continue this bearish trajectory. The key caveat is 118.41. That ultimately is the level that tells us we've got legs on the move that we're seeing at the moment for cable. And then looking at the Australian dollar, the Aussie dollar has also been selling off recently. That comes off the back of a rally into 71.37. That was the peak that we had established here in mid-August. The wider trend is a bearish one, but if you look at what's been happening over the past, say, 4 months, we have got a very clear bullish trend in play. Now, more recently, we've got this sort of head and shoulders formation. If I grab the tool and draw this on, we'll be able to see that. Do you know what? There we go. It's done it again. Head. Right shoulder. There we go. So that points towards a potential for a sell-off from here. But we're starting to pick up pace here. Now, bear in mind that this wider trend has this trend of higher highs, higher lows. So we could be retracing the rally from 66.29. So 68.31 has been respected alongside that 200-day SMA as things stand. And we're starting to move higher. Crucially, for the bulls to gain more prominence, you'd need to see a move through 70.29, which then points us in the direction of that previous resistance level, 71.37, 71.57, which is the top end of this head. So near term, we could see some upside, but certainly this head and shoulders formation does point towards a possibility of a reversal here. I would say arguably there's stories on both sides. I wouldn't necessarily say I've got huge conviction for this one, just because, yes, we've seen this head and shoulders formation, but we still do have this bullish trend playing out over recent months. So regaining ground here, certainly if we break through the 70.29, that's going to give us greater confidence towards the upside. And towards the downside, look, ultimately we need to break the 66.29 for this trend, this recent bullish trend, to essentially be negated. So arguments on both sides for this one. 4-hour chart does show you that we've rallied up, much like the other pairs, towards but not through your more recent swing high, 69.36, and therefore there is a chance that we could see this market roll over here to continue on this recent vein. So keep an eye out for 69.36. If we break through that level, it gives us greater confidence that we could move up towards this 70.29, or at least into a deeper retracement. But until that 69.36 mark is broken, it's a good chance we could see this market start to roll over from here. Looking at the commodity space, gold has certainly been coming under some pressure of late. That comes as people start to see more of a risk-off sentiment within markets. Historically, people would perceive risk-off as being good for gold. Not necessarily the case here. I think a lot of this risk-off move that we've seen in the past that's been beneficial for gold has been around the fact that people have perceived central banks as being requiring a move into a highly accommodative stance. Well, this time around, we've seen the opposite. We've seen risk off because of the fact that interest rates are likely to be raised once again. Now, let's just take this out onto the weekly time frame. We can see here that we have been pulling off very heavily after a protracted multi-month period of upside. So this could be the beginning of a bearish phase for this market, and a lot of it's going to come down to what's happening in terms of the US dollar. If we see the US dollar come back into prominence, we're likely to see gold selling off. At the moment, we're seeing a sort of what looks like a rebound coming into play, coming off the back of this retracement in towards the 61.8 Fibonacci level. Certainly this bullish phase doesn't necessarily look to be over entirely because of the fact that we still do have this potential for this to be a wider retracement here. So we could be regaining ground, but ultimately we need to see the 1890 level broken for this recovery to look like anything other than a retracement before we sell off once again. So near term, are we going to see much of a move higher? Well, we've come into this confluence of the descending trend line and this near-term swing high of 1845. That points towards the possibility that this market's going to roll over once again. Stochastics into overbought and starting to look like we're going to cross soon enough. So momentum looks to be waning somewhat, as you can see, with the fact that we're now in the red over this current candle. But so certainly, I think there's a good chance that we do see this market roll over once again from trendline resistance. If we were to break up through this trend line and see a close, then we're looking for a wider retracement of the sell-off from 1890. But until that happens, I think there's a good chance that we do continue on this bearish trajectory. I think it's going to be a gradual move. I don't expect to see fireworks today just because of the fact that we've got the closure of US markets. So that could keep things very relatively quiet on the volume front in terms of the US dollar. And then finally, looking at Brent crude. Brent crude has worked out very well. We were looking for a short in Brent crude on the trade of the week for last week, and it's worked out perfectly. The justification for that was this descending trend line alongside this 100-day SMA and the 76.4. That confluence looked to me like the kind of area where we could see this market roll over. And that's exactly how it's played out thus far. I mean, look, ultimately, the risk here within this trend was we still have the possibility of creating that higher high. But for me, I thought there was a good chance we were going to come into trend line and start to roll over like we have in the past. And so the 4-hour chart shows us we've tagged that 76.4 Fibonacci level, sold into a head and shoulders formation. Now we've capitulated in down below that $82 mark. So we're regaining ground here. I don't think this is going to last. I expect us to see this market falter once again. Whether we want to take trades at a deep retracement, whether we want to take trades on seeing an intraday bearish reversal signal, different ways of playing this. Ultimately, this is the 15-minute chart. As one way you could do it is looking for a breakdown through your near-term support, which is 83.11, looking for a continuation of that to signal that we're going to continue climbing. There's a number of ways of playing it, but ultimately for me, unless we break the 85.97, which would also necessitate a move through trendline resistance, I think there's a good chance that this near-term rebound is going to falter once again to see Brent crude turning back lower. That's it for today. If you want any more news and analysis, make sure to go onto the IG platform. Other than that, follow me on Twitter. My name is Josh Mahoney here at IG. Have a great day and good luck trading. Thank you.